Good afternoon, guys. Let's get started. It's Sunday, May 23rd. My name is Dave Coker, and this is, of course, Talking About Finance. You know the routine by now. 7 sides for 7 days. Just what me and my buddies are talking about all week, right? Well, we talk about a lot more. I bring the best to you. Now, here's an interesting one. The market's getting a little odd. And normally, what we're looking at here is we're looking at Treasury futures, 10 years, the 10-year note future, and we're looking at the S&P 500 futures. So we're looking at risk-free assets, US Treasuries, compared to risky assets, the S&P 500. We're looking at 60-day correlation. And the thing that's really fascinating about this, guys, look on the extreme right-hand side. We can see the correlations are going perfect positive, or strongly positive, I should say. In fact, they're near record numbers. And this is very, very abnormal because it looks like everybody's trading in the same direction. Normally, as and the chart will support this, normally we see negative correlation between stocks and bonds, or we see slightly positive correlation. Certainly nothing quite like we're seeing here. It's a very, very odd time. A lot of money sloshing into the market, asset prices going high, hitting new records in some cases, although we've had a little weakness recently. And that reminds me of a gentleman called Bill O'Neill. If you've never heard of Bill O'Neill, he's very influential on Wall Street, owns a fairly large brokerage. I don't think he sold it, but it's actually pretty large. Writes a lot of market commentary, excellent guy to chat with. And he founded Investors Business Daily, IBD, back in '84. I used to read that when I was in New York. I haven't looked at it for quite a while, although I've looked at articles on the web. I presently subscribe to Barron's and a few other publications, but IBD is solid. And this is very fascinating when he was talking about the dot-com bubble, about people will be shocked at how low prices will go and how fast it will happen. And there's certainly a parallel with what we're seeing now with all the liquidity sloshing into the markets, driving asset prices up to record levels. It's going to be very interesting. And if you've never been through a market crash like the dot-com crash, this will illustrate what the severity of it. This is, diamond hands, of course, from the meme traders over at Reddit. And they've got these guys that just say they've got diamond hands. They're going to buy GameStop, for instance, and ride it up and ride it down. When any rational investor might take profits when you bought it like $20 and it's trading at 400, you might want to take some money off the table. These guys, got to respect them for that. But in any case, that's what we mean by diamond hands. And here we go, guys. Check this out. This is Amazon during the dot-com crash. My gosh, it dropped over 90%. Look at the right-hand side. Yet that's $6.01 a share. And on the left-hand side, it topped out at about 132, I believe, before it corrected, before it crashed. You can see the drop, 93.61%. The lower part of the chart shows this. Now, a couple points to keep in mind. First of all, this was epic. And I love looking at this chart because it's historic. And I rode that crash. I was positioned very well to make money in it. I wasn't short. I don't do that crazy stuff, right? But guys, I'll tell you a little bit more later about what I was holding. Well, I'll just tell you right now, REITs. I had a portfolio full of REITs. I didn't go near the tech stuff. And after the crash, everyone wanted REITs. So I made a bucket of money on that crash. But in any case, the key takeaway here from this is that growth companies, new growth companies, or new technologies are very volatile. They've got major drawdowns and major advances as well. If you'd held Amazon from that period of time on, from the top, I should say, up to the present, you'd be up well over 30%. And if you had actually timed the market, which you can't do, but let's just say you bought at the bottom, you'd be up about 540%. I have run the numbers recently. It's absolutely amazing. So guys, just buy and hold and don't mess around. Don't try to trade. It's, really, really can't do it. But this shows you what Bill was saying. It's really amazing when these things drop. They drop like rocks. And chips. This is a wonderful one. What we're doing here, guys, is we're looking at used cars. We're looking at used car value index. Basically, what's going on with the used car market and the average price of a used car. And on the right-hand side, you'll see it's gone parabolic. Absolutely incredible. So why would people be willing to pay so much for used cars? Well, they can't get new cars. It's really that simple. The COVID crash or pandemic curtailed new car production last year. And now this year we've got a chip shortage. So they can't get the chips to put in the new cars. It's really damaging their ability to make cars. And consequently, that echoes into other parts of the market. And used cars, my God, they're going to the moon. A good friend of mine, she's got, her family's got 3 used cars, each about 5 to 7 years old. And I told her, I said, look, you got to sell these things. You're going to be rich. It's amazing. Yeah, she's not going to sell them because they live out in the country and they need a car. It's unfortunate that she can't monetize it or take advantage of this opportunity, I should say. But it is what it is. And whenever we see things, guys, any predictions coming out, you got to be extremely careful. Let's back up a minute. Mr. Musk, Elon, he badmouthed Bitcoin. Bitcoin crashed. All cryptos crashed, actually. And he was complaining about the energy use, blah, blah, blah. Well, I heard some pretty strong and pretty factual statements coming from that side of the market about Bitcoin's energy use now and where it would be in a few years. And I got a long memory, guys. And I think back about in 2017 when Newsweek published this. And, I think we're past 2020. We're in 2021. I don't think it's using all the world's energy, but that was the prevailing view back in 2017. I remember distinctly, I was buying Bitcoin, as I shared with you guys, every Friday night back then. And yeah, we heard this and I didn't believe it then. Clearly you don't believe it now. And Mr. Musk's predictions will turn out to be wrong as well. The entire planet is going green, most of the G20, I should say. And we're always looking for ways to make money. Well, look who's going to benefit from the world going green. I love it. It's fantastic. China is going to be making buckets of money because they've got the raw materials that they need. And check out the 3 areas that they dominate. I mean, amazing chunk of the market there. So we're always looking for ways to make money. Chinese, wonderful, good for them. They're going to be making buckets of money because they've got large scale, the size of the production. And that's okay. There's a lot of Chinese firms listed in the US or Europe, so we can get a piece of this action if we're so inclined. And home prices, lots of news about home prices hitting record highs in the States. It's amazing. I know people trying to buy houses and they come into the market and they're going to do a cash deal for, say $400,000 or $500,000, and people are outbidding them. They're bidding, 30% higher. Cash deals as well. There's a lot of money sloshing around. It's driving a lot of weirdness in the market. Now, you might wonder, why is the number of transactions falling? So what we're looking at here, guys, I'm sorry, I didn't explain it. We're looking at the number of transactions, the aggregate number of transactions, and it's falling. So why is that even as home prices hit records? Well, really interesting stuff. We see that purchase applications, they're down about 4% week on week. They're only up year on year by about 2%. It's really amazing. Here's what's going on. I had to make a few phone calls, Skypes, and talk to some buddies out on the West Coast and the big mortgage banks just to see what was going on. We've seen price increases north of 30% year on year across the entire market. The banks are getting worried. So the banks are tightening lending standards. They're tightening appraisals. They're requiring tighter appraisals, more detailed appraisals. They're trying to slow down the market. And also the ratings agencies, the credit ratings agencies, the bureaus are involved in this as well. They're changing the definitions of credit scores. So they're both of these entities, or these groups of, or people I should say, are trying to cool down the market because the Fed ain't going to do it. So it's really up to the private individuals to do it. All right, guys, that's it for this week's Talking About Finance. It's been wonderful. Hope you have a safe and profitable week. Overnight trading in Asia, in the Gulf region right now looks pretty good. We'll wait to see Asia coming online in about 4 hours. And then, of course, we've got the European Open as well as the New York Open. You're going to make money, though. Just keep your eyes open. All right, guys, thanks for your time. Take care.